Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, a lot of discussion about when the Fed's going to cut rates. We had a recent inflation data come out for CPI for the month of February. It moved lower, but still elevated. Now, the shelter component, the largest component of CPI, remains the largest driver of inflation, down from January, but still significant at plus 5.8% year over year. Let's talk about why I think that will still decline over the next 12 months. And equity valuations. Earnings have been pretty strong over the past 12 months and post-pandemic, but if you're looking back historically, they're pretty high and well above average, especially those Magnificent Seven stocks. Now, CPI inflation just came out during the past week for the month of February. It came in at 3.2% year over year. You can see that on the far right for the month of February. So prices of goods and services in the US, 3.2% higher than 12 months ago. You can see on the chart the breakdown here of the various components. That green stands out at plus 2% of that 3.2%. The largest majority is shelter. All right. And if you isolate that specifically, it's at plus 5.8% year over year. Now, that's the largest driver. And if you look at it without that shelter component, over the past 6 months, the CPI is at an annualized rate of 1.8%. So you can see how impactful that is. Now, why is this potentially not as worrisome as it seems on the surface? Well, at 5.8%, that's still pretty elevated relative to a year ago. Now, that comes on the heels of January, where we saw a pretty surprising CPI shelter component raise of 6.9%. And if you take that out, both January and February, and obviously the months prior to that, you can see that inflation jumped up significantly during 21 and 22, down significantly, but well below that Fed's long-term inflation target of 2% rather, sitting at 1.8% annualized during the past 6 months. Now, take a look at some reasons why we would expect that shelter component to probably come down. If you look at the Zillow rent index year over year, you can see that is on the red dotted line. The dark blue is the CPI rents year over year. You can see it's much more elevated. Historically, Zillow has tracked pretty close and actually led the CPI component. And as you look at Zillow, it has dropped significantly, down around 2.5%. Well below that 5.8% year over year rental component within the CPI. So we would expect, unless something changes, the path forward looks like rental prices, that component should come down for CPI, which is the large driver, and the Fed's path of rate cuts by mid-year seems highly likely. Now, equity valuations, right? The price people are paying for future expected earnings are still pretty high. So we have that, what looks up there, NTM. That means next 12 months. A lot of times you'll see trailing 12 months PE ratio. This looks at analyst estimates for price to earnings ratios for the next 12 months. So looking at 12 months earnings compared to today's prices, you can see in the dark blue line, the Mag 7. That's the Magnificent Seven. All those big tech stocks, NVIDIA and Microsoft and Meta and so on. They have a next 12 months price to earnings ratio of 29.8. Very elevated relative to the rest of the market. Not surprising given the big expectations for the investments in artificial intelligence and some of the companies that are real market leaders and earning that, if you will, but also valuations are quite stretched in that area. Now, if you look at the median in the gray and the red is just the absolute market cap average, you can see 20.7 and 18.3 respectively. Those are both well above the long-term average of 16.8. So slightly elevated. If you look historically, I don't think you can argue this market is cheap. And so this could be a tailwind when you look out over the next several years, is that the market is priced for its earnings at a pretty hefty valuation relative to history, not on the cheap side at this point. Now, airlines, their concerns, United Airlines, Southwest, all these different airlines are coming in and saying, lowering forecasts, saying we're going to pause hiring for pilots. Why is that? Well, Boeing, the airline manufacturer, has been in quite the hot seat during the past several months. If you remember, most notably, they had a flight where a an emergency door, flew off mid-flight. Came out information later that said it wasn't bolted properly by the manufacturer. Not good. They've had a litany of other ones where tires fell off and flew and hit cars recently. They're dealing with quality control issues in courts and congressional hearings, really trying to ramp down safety. What's that causing? That focus on safety. It's causing delays on Boeing Max and some of their other new airlines. It's starting to impact those airline companies who are essentially saying, once Boeing gets it together, we can really operate, because they rely on the manufacture of those planes to obviously meet those travel demands for customers. So hopefully Boeing can get it figured out for the safety and also for the airline industry overall. With that said, I want to thank everyone for watching, and I'll see you next time.